There's only one reason that stocks go up and down, and it's very simple. Stocks go up and down because buyers are willing to pay more or less for companies. I will now await my Nobel Prize. I'm kidding, of course, but what I said is 100% true. Markets for stocks are no different than markets for oil, or corn, or cars, in that everything is worth what its purchaser is willing to pay for it. If I incorporated a company tomorrow called Benz AI with a business idea of selling access to AI models with a 5% markup and a pension fund bought it for $1 trillion, then my company is worth $1 trillion, even though it does no revenue, has no employees, no assets, really does nothing at all. If somebody pays $1 trillion for it, it is worth $1 trillion. Of course, the obvious question in your head right now is where things start to get interesting in the world of finance. Because that question, why would a pension pay $1 trillion for my bad sounding business, is that they wouldn't. Because as of today, a random company with a bad name started by a low profile person is not a company that the vast majority of investors would think will be worth money one day. Their expectations for the company are low, and accordingly, the amount they pay for it will be low, or even more likely, zero. Now let's take a look at a different example and take a startup building in a space with real potential, building something that will have value. And not only that, it's being built by some of the most successful and experienced entrepreneurs on the planet, who have navigated company building from launch to IPO in operationally hard spaces in the past. Your future expectations about that company are probably a lot better than for my spitballed AI resale business. How much more the market would pay is up to the market, but I think we're both willing to bet that it would pay a lot more than it would for my business. And we actually have recent examples of just this type of thing happening. Jeff Bezos, the Amazon founder's new company Prometheus, recently raised $12 billion at a $41 billion valuation. The reason Bezos was able to raise at that valuation is because, with all the facts considered, the market is a lot more confident in the future prospects for his business than they were in my hypothetical business. Now, while that's a very high valuation for an early stage private company, the valuation of Bezos' company is nothing compared to public market giants like Google. And in your head, you can again probably figure out the fairly obvious answer for why Google, technically Alphabet, is worth more. And yes, it does have to do with Google making many billions in profit and having hundreds of billions in assets. But that's actually not really where the vast majority of value for a company like Google comes from. Instead, the value of someone like Google comes from the fact that investors are significantly more confident that Google can keep making billions of dollars well into the future than it is confident about Bezos' startup making billions of dollars each year into its future. Of course, if Bezos' company succeeds and deploys successfully, generates strong growth, whatever, the market may start to believe that it does have a much higher chance of making those billions or even trillions of dollars, and accordingly, it will be willing to pay a higher price, and vice versa. The important takeaway from all this is that prices of all companies, whether the earliest stage startup or the slow-growing mature public company, are always set by expectations about the future. The startup with a seemingly crazy revenue multiple is simply a reflection that the market believes that company has a very plausible shot of making a lot more money very quickly. And in a lot of startups, that turns out to be 100% true. Often the exact price will move based on things like the founder, how investors feel about the industry, the quality of contracts signed, but all of those are just inputs to answering the questions of how big the future could be and how likely that future is to happen. And the same process happens in public markets. For example, Costco is valued at a premium to a company like Nvidia, its sector, and the market as a whole. But the reason Costco trades that way is because markets expect that the future for Costco looks a lot better than the present, but a lot more importantly in Costco's case, the market has an almost rock-hard belief in Costco's ability to see that vision through to reality, in part because of some of their impossible-to-replicate accumulating advantages. Now, that discussion might have you thinking about the final question that will help to understand why stocks go up. How does the market decide what the future looks like? And the answer is that the market doesn't know. All the market is doing is aggregating opinions and weighting those opinions based on dollars at play. Each investor is making their own determination every single trading day by deciding whether to buy, hold, or sell based on the information currently available to them about what the future of the company might look like. Now, actually seeing the future is far easier said than done. The majority of stocks end up being negative returners, and only about 5% of stocks end up being material contributors to overall index returns. Hence why the vast majority of us are far better off with index funds. But at its core, all the market is a daily vote about future expectations. And if you know the future better, you win. While there's a lifetime of videos and nuances buried in what I've said today, the core really is as simple as stock prices move because investors' expectations about the future change. That's it. That's the entire motion that trillions of dollars in human wealth follow every single day.